Oh my gosh, is the Austin housing market floating along or are we sinking? The answer to that and many more questions this week in the Austin Marketing Housing Update. Because you know what, folks? Whether you're building a single family residence or a multifamily residence in the Austin to San Antonio corridor, there is a lot going on and there are many parallels. We're going to talk about mortgage qualifications and the Bank of America and how that's not affecting our Austin housing market, but how it is affecting other markets and what is going on in the global economy. And with that said, I am going to bring on my amazing co host, Mr. Mark Koretsky, who this week is wearing a shirt that says Movement Mortgage. So I cannot
You
mess
are
up
welcome.
with his company.
You are welcome. It's so good to be here. Jennifer, you look great.
Thank you, Mark. I dressed up for you today.
I appreciate it.
Well, let's jump into it because there's a lot going on, and I'm going to keep it as light and tight as we can for the folks who are tuning in. And we do appreciate you folks. And by the way, if you do have questions at all, we always love to hear from you. Please make a comment below and let us know your thoughts, what you're experiencing in the Austin housing market or the mortgage space. With that said, Austin has over 97 homes for sale this week, and we've had a slight uptick in how many houses have had a price reduction. Mark, are you shocked?
I am not.
Tell me more.
We're seeing it everywhere, right? I mean, it's a lot of sellers really just the gap between what they believe they're going to get and what the reality is just getting greater and greater. And the reality is there are a lot fewer buyers out there in the market today. And so that's going to mean less eyeballs, and that's going to mean less offers, and that's going to mean you're going to more likely than not have the opportunity to reduce the price.
Yeah, we had 962 houses come on to the market this past week. And when we look at last week versus this week, 285 more houses had price decreases versus the number that we had last week. 285 out of 98, almost 9,900.
I mean, this is the thing with real estate, right? Like there are ups and downs, and
Totally.
we are coming off of some of the greatest ups, and we're going to see some downs, right? Like that's the reality of the situation, and that's totally normal. Like
Yep.
that's the way it's always been, and we hope that really that's the way that it'll continue to be because that's healthy.
Agreed. And when we look at the numbers, 10% of all of the homes, so just over like 920, I think, houses went from under contract last week or pending. So
Yeah.
that's 10%.
And I mean, we're still like, if we take out these last 24 months that we all lived through,
Mhm.
the market today and like the actual like list to contract and then contract to close, like it's still faster than 2019. It's
Oh, yeah.
faster than 2018. And so I feel like I'm always here to just remind everybody like everything is relative. And so I think the only thing that matters is whether or not somebody needs to go out and buy and sell real estate. And if they do, then it doesn't really, they're not going to be able to time the market. Those needs come upon them when they come up, right? And so we're dealt the cards that were dealt, and it's all about trying to make the most of it.
Absolutely. And, I was at a really great event last week, and I'm going to do a separate video on this. And we were talking about what is happening in the multifamily unit housing market and to hear the parallels of what's going on with the multifamily space as well as the single family residence, which is where, a lot of the times you and I are spending our time discussing and working with our clients. The parallels are uncanny. If you think it's hard to get materials to build one house, imagine what that looks like when you're building, several and you're waiting for how many doors and how many windows or how many garage doors. It's crazy.
Yeah, I mean, you didn't even bring up like government regulation and like the ability to get permits and actually like break ground. Like there is so much that goes into actually getting a finished piece of inventory. So yeah, I mean, there's potential pitfalls and hurdles at every stage of the build.
Absolutely. And Austin is like literally one of the hardest markets. And so this was a room full of folks that had flown in from all over the place. And Austin is one of their favorite markets. And it's also one of the most stringent, has the most stringent guidelines when it comes time to permitting and getting things through. So not only is it hard to permit, but the process itself is effectively that much longer for these builders. So their carrying costs are that much higher.
For anybody that's spent any time in Texas, that comes with no surprise.
Exactly. Well, and Austin being our own little island.
That's exactly what I mean.
Yeah. Yeah, for sure. And so one of the things they were talking about was as their values have increased, the question, just like for my single family home investors, as well as owners, is like their housing has increased. And so now there are other things that the question is, has it been able to increase because the taxes have also increased, as you know, their insurance has increased, as you know. So now it's like what's happening to rents. So if you are an investor in Austin and you're looking to rent, rents have gone up like year over year, 35%.
Ooh.
Yeah.
Yeah.
Big numbers. Big numbers. And
you compare that to, I mean, what we're seeing. So what we're really seeing, I believe, is just a cost of living increase. And it's not just you in Austin. It's not just me in the DFW. Like, it's coast to coast.
Yeah.
What it comes down to is, yes, we've got all of the difficulty with the supply chain and like the logistics that goes into it. The reality is we have a lot of people that need shelter. And so we're going to continue to see this.
Mhm.
I think what we really need to concentrate on locally is, and I've seen some bills being brought up and in process, but we really need to figure out a way to cap these increases that counties are able to just do. I don't know if you know this, Jennifer. We have the biggest, why can't I think of the word? We have the biggest surplus of funds in the state of Texas, in the history of the state of Texas. We have a surplus of funds that we've generated,
mm-hmm.
and there's very little talk about giving that back to the homeowners.
Mm-hmm.
And even when there have been these discussions of, oh, we're actually a fiscally responsible state and we have a surplus, when Congress tries to give it back to the people, a lot of the time it really gets stuck at that county level. And so I think we need to put a big focus on really what we allow the county officials to get away with, because it's, I mean, we all act in our own best interest, right? And as much as those county officials are residents of that county, they're representing their own best interests. And for the government and for the county, they can take and keep all the money that they want right now.
Well, yeah, and so there's a couple things there. Number one is obviously they're voting to get
not just county, city too. Sorry.
They've given in Austin, they've given themselves raises. And really, though, one of the things that they are looking at, which we need to for our future selves, is to look at the infrastructure and what is going on for the city. Like Dripping Springs just lifted the moratorium on building, which has been going on for a long time because they were lacking infrastructure and there were concerns around their water, amongst other things, and how to make sure that people had good, clean water. And so what's happening with our roadways, we are limited on our sort of east-west corridors here in Austin. So you have to go like way, way north to kind of cut across. Like there aren't a lot of cut throughs. And when we look at where we are seeing so much growth from the tech corridors and out to, I mean, we're seeing it everywhere, right? Obviously in the north, we're seeing a lot more courtesy of those tech firms. And then in the south, we're starting to see all sorts of things in Kyle and Buda and Bastrop and all of the places along the corridor heading to San Antonio. And yet we don't have, you're either on 75 or you're on 35, and there's not that way to cut across. So infrastructure for us, which is a lot of things that I continuously look at because it pertains to the housing values, the taxes, all of the things, right? So I'm with you. Like, what problems are they solving for? with all the money that they're sitting on?
I don't know, but I think the only way to really find out is to get involved and to actually
Mhm.
be there and
Yeah,
participate in holding our officials accountable, right? And I think
absolutely.
it's really easy for me to say, like, I'm not doing it. I'll be the first to like admit, like, I don't want to be, I don't want to come off as that, but like, we all need to get more involved, especially us that are real estate professionals, because we see the ramifications of do's and do nots, right? And so I think we need to bring our voice to the forefront. But I think before we can do that, we really need to know what's on the agenda and what isn't, and then we can start talking about why.
Yeah, I think, that is totally a fair point. And I mean, I can tell you that I am reading every day up on what is happening with our city, what's happening on the residential side, the commercial side, what announcements are being made to the outside world so that people can see what is happening in Austin, Texas, and why, to your point, when we were talking off camera earlier, why we will likely never hit a buyer's market and continue to remain under 6 months of inventory and steadily remain in a seller's market.
There's so many reasons why. I mean, you brought it up a second ago. What we were really talking about is the reality that I'm seeing, which is homeowners that really should be upsizing right now. And like now their kids are in school and now they actually have the ability to go and upsize. They're looking at their payments that they refinanced back in whether 2020 or last year in 2021, and they're looking at today's rates and they're comparing their payments, and it may not be adding up. And so a lot of them are looking at more home improvement projects and
Mhm.
reno and actually doing additions on their home. And obviously, you know how difficult that is within city limits, but they're not making any more land. And so I think that implication we're going to feel for years to come.
Yeah.
I think we're going to have a lot less buyers that are willing and able to actually go get a new loan.
Mhm.
So I think we need to, at the end of the day, be the professionals.
Yep.
I mean, empathize with buyers, empathize with sellers, and really just try to make sure that we're working towards achieving their goals. And sometimes that may not be buying and selling real estate.
Oh, for sure, for sure. I can tell you how many times I have conversations with my buyers and with my sellers, and where if they're considering whether they're considering downsizing, so to speak, from a footprint standpoint. Um, but if they're out in the West End and they're getting, say $450 a square foot for their house, but then they're moving downtown and they want to buy a condo and it's $1,000 a square foot. Well, they are reducing their footprint in the world. They're not necessarily exchanging an economic footprint because their HOA in the West End and the cost of the club membership and the upkeep of their big house, you take all of those same expenses and then you move it into a condo with less upkeep, then you may not fiscally be changing your lifestyle, but you are definitely changing your spatial. And with that said,
Well,
as we
it's a massive lifestyle change, right?
huge, huge.
But does it make sense for everybody to go from let's say 4,000 square foot house with maybe a $2,500, $3,000 payment to go to a 1,000, 1,200, 1,500 square foot condo with that same payment?
Right.
I don't know. I'll take that extra space all day.
Yeah. Well, yeah. Well, you would, but and you're in a different stage of your life, right?
For
And
sure.
so there does get to be it's the economy of lifestyle, and the trade-offs of what really does develop into that lifestyle. And so the other thing I'm going to talk about, speaking of lifestyle, is right now when we look at the prices of our lending, there are two things I'd love us to talk about going forward. So stick with us here, folks. And if you have any thoughts on what we've been talking about so far, what are your thoughts? Would you trade your downtown house for our downtown space for something bigger outside city limits, or would you trade your bigger space and consider moving into downtown, we would love to hear from you. Please let us know. But Mark, that cost of borrowing money right now, let's talk about that, because we were saying, rates are floating above 6 now, and what that looks like potentially for people who are buying and selling.
Well, so this is a big week. We've got the Fed meeting, or really the announcement of the meeting. We, for the first time really since June, are at our worst levels. Rates have now gone, they've actually gone up above 6.25. And that's a really important level within markets. I'm not going to get into all of the specifics, but right now we're really at a crossroads. The Fed, what they're doing, and there is so much misunderstanding and confusion about this, but the Fed is increasing rates, right? Everybody's talking about it. It's on every headline. That's not talking about mortgage rates.
Correct.
That's talking about overnight lending rates.
Yep.
And so if you can get money overnight as a big bank and it's really cheap, that means money is available. That is inflationary, right? Inflation is really the reason why mortgage rates are up. It's the last couple of reports, we were expecting them to show bigger signs of a decrease in inflation. We didn't see that. And so that actually pushed mortgage rates up. Right now, what we don't know is the Fed going to raise the overnight rate? Are they going to do it 0.75 of a point, or are they actually going to do a full measure and a full 1% increase? What makes very little sense to most people, even mortgage bankers and real estate people, the higher they hike these rates, the more likely it is that we actually see mortgage rates come down, which is completely counterintuitive, but that's the reality of the situation. And so this week we're at a crossroads. If the market looks at that 0.75 point increase and we get some more reports that show that inflation is not subsiding, then we could see mortgage rates continue to go up. If we get a good sentiment from the Fed and we get some reports showing that inflation is creeping down, we could very likely see ourselves go back into that 5.25, 5.75 range that we've talked about. And so right now we jumped out of the range. The question is are we going to keep going up, or are we going to come back down? The challenge is a lot of money is in the sidelines, and very little money is going into mortgage-backed securities right now. And the 10-year Treasury is also at that 3.5%. It's a huge barrier. If we jump above that, it could climb very quickly. And so we're in a place where we've got to be looking at everything and being able to really diagnose it. Right now, I'm foreseeing that we really, this is the worst that it gets. Is that the optimist in me? I don't really think I'm an optimist. I don't really think I'm a pessimist. I think I'm a realist. Right now, it's just there's no money that's flowing into any market. And so once we get indication that inflation, not just here, but then also in Europe, which is a whole more complicated issue, but once we get those indicators, that's where rates really come down. That's where all of this money goes flowing right back into the market. And then it's going to really push rates down even further.
Yeah, and they the guys I was talking with, and ladies, and on the side of the multifamily, we're talking about how the institutional buyers are sitting out now because their cost of borrowing is higher as well. The good news is, in Austin, as in other places, with those guys sitting out, you no longer have to compete with these big cash buyers to purchase your home. And when you're working with a realtor that obviously knows what they're doing and can explain value to you as a buyer, as well as that to a seller, and negotiate on your behalf, then there are opportunities in the market that did not exist when we were in this crazy pace that we were in only a few months ago. So there are huge opportunities in that sense, not only in the single family side, but on the multifamily residential side, if you're looking at investing, that did not exist 3 to 5 months ago.
As you were talking, I'm kind of smiling to myself. Gone are the days of waiving appraisals, it feels like, at least for us up here.
Mhm.
Well, I guess really it depends on the price point.
Sure.
At the same time, like what I'm seeing with the contracts that we are getting and the appraisals that we're receiving, they're coming in over contract. And it's not just a one-off here and there. Like pretty consistently, the purchase prices are below the appraised values on these properties. And I'm having a lot of conversations and explaining to my clients why we can't take advantage of that appraisal difference, meaning like with it being higher, because on the lending side, we can only finance somebody off of whatever is less, either that purchase price or that appraised value. And so we're having a lot of conversations of actually increasing the purchase price, getting seller concessions
Yep.
to offset, and then figuring out the best way to allocate that money.
Okay, so if you didn't catch that, Mark, repeat it one more time because this is a really big point for buyers and negotiating with sellers in order to have your dollar go further.
So on the lending side, we can only finance a buyer off of whatever is less, either that purchase price that is agreed upon on the contract or whatever this independent appraiser, third party, their value opinion is. And so what we're seeing recently is these opinions of value coming in higher than the purchase price. And so with us having time on at our kind of in our advantage, we have the ability to actually propose to the buyer and the agents, like, let's go back to the seller, let's actually increase the purchase price. Let's say we can increase it $5,000 to get the seller the same amount. You can increase the price $5,000. Let's just use round numbers, get a $5,000 concession from the seller. And now the buyer and I can really go to work strategizing on what's the best way to allocate that money.
All right. So thank you for that. I'm glad. Thank you for expanding on it a little bit. So with that said, I promised the folks in our intro that we were going to talk about what the heck is going on with the Bank of America and the new program that they just brought out for certain economic spaces. And there are a number of things going on in that realm. And some of the world is acting like this is brand new and oh my gosh, and we're going back to 2008. I don't believe that is the case. However, the fact that they have made these no money down mortgage.
Allegedly, right?
Yeah. Well, there's no money down, no PMI, and no closing costs if you qualify for this particular type of loan with the Bank of America.
So I have a lot of opinions on this. Number one, I'm just going to say I'm an advocate for home ownership. And
Ditto.
so for anybody that is able to take advantage of this program and qualify and take advantage of home ownership and actually get affordable home ownership, go do it. Absolutely. Yep. The other side of me is like, hey, to your point, like this isn't a new concept, right?
Right.
What it really comes down to from the technical aspect is me as a mortgage banker that doesn't work for a bank. I can only do loans based off of these federal guidelines from Fannie Mae, Freddie Mac, FHA, VA, USDA, right?
Yeah.
When you're a depository institution, meaning a bank, you can lend your own money. And if you want to lend your money to whatever characteristic of borrower, you can. That's the reality. That's what we call portfolio lending. On the banking side, there's a lot. It's a different view on kind of the regulations and the licensing requirements and everything, right?
Oh, yeah.
And it should be, right? Like they're a depository. We don't actually accept your deposit. So when you're a depository, you in one way or another have to participate in Community Reinvestment Act lending. And that's where really the government comes in and says, hey, you're not lending to somebody with lower income, lower credit in these areas. And it's looking like it's discriminatory and you need to. And so it's really kind of a carve out from the reality, which is like the requirements for this program are very discriminatory, right? Like you have to be in this plot like geographic, you then need to be in a subplot, you then need to be some sort of demographic, you then like et cetera, et cetera, et cetera. We can't do that. Like that's discriminatory for us to come out with and do. What I don't know is this program really under the Community Reinvestment Act? I haven't seen anything to really confirm or deny that. What I have seen is that out of the banks, I mean, all of them have very low approval rates for minorities, but Bank of America has the worst of it. And so to me, it's no surprise, like, hey, before we get our hand truly slapped and or like hit on the head, like we've got to do this to basically cover our own asses, right? CYA. And so I think that's a lot of what's going on. I haven't really seen anybody like officially take advantage of the program and close on it. I would love to talk to you if you have. So if you're watching, you've actually taken advantage of the BOA offer, like let us know, post a comment, give us some details, like not personal info, but like tell us how your experience was, tell us like whatever you're comfortable telling us, right? I think it would be really good for us as real estate professionals to actually hear both the success stories and then the reality stories, but then also just to get your feedback.
Yeah, I appreciate it. And for those of you who are thinking about buying or selling in Austin, you cannot buy in Austin with this particular program through the Bank of America. However, you can buy in Dallas, which is actually Mark's backyard. He's good for the whole state of Texas, but Dallas is one of the tester markets. And or if you have friends or family and you need to have them get linked up with a really great realtor as well, I know some incredible heart-centered, fully engaged in the economy and what is going on in with the Bank of America, as well as other things that are happening for your socioeconomic category that will be allowed to do that. And the thing that gets me is the consideration of while they're looking through all of this as an economics, that people who have had, have proven that they can consistently pay down what it is they've borrowed, et cetera, and they've got the rent and they can show all of these things. The biggest considerations is now you also have a property tax that's going to go up. You have the cost of home upkeep, that's going to come up in terms of repairs, and then you've got insurance as that third leg. So if you do have somebody that you know and love and care about, please, like Mark said, reach out to us. Let us get them with the right folks that can actually do that, like take like a magnifying glass and work with them to ensure that when it comes time to affording a home for the purposes of creating their own economic sanctuary, that we get them with somebody who can really sit down and do the math, because I can't imagine the heartache of what it would be like to actually have the dream of home ownership fulfilled only to then have it yanked out if all of those things aren't considered. So Bank of America, well, it is a slap on the wrist, and I have my own misgivings about this. There's another part of me that has a belief that there are some families that are going to get to the joy of the American dream of home ownership through this. So,
well, I just got the goosebumps, but I mean, as you were talking about, I keep thinking like here at Movement, we use the word love and value a lot, but we define love as acting in somebody's long-term best interest. And that really is the way that I operate. It's what I require of any of my partners. And so I know, Jennifer, that's the way that you operate. And that's the way that we really hold our networks. That's the standard that we set, right? And so I think in anybody's long-term best interest, number one, make sure you get yourself monthly affordability. That's what you're signing up for. Like, yes, the excitement is in the house, but once that excitement wears off, like you've got this payment, make sure you can afford it.
Yep.
Keep the cost down as you're doing it, because the reality is this isn't your forever mortgage. And so whenever you go to refinance, you're going to have cost again. Let's try to minimize the cost, maximize the benefit. And then at the end of the day, like, don't sink all of your money into your house, whether the market is climbing, whether the market's retracting, whatever money you throw into the house, like it's there until you sell it. So get yourself an affordable payment. Don't throw the extra money at the house. Keep that in reserves. Keep that in investments. But that's kind of where I would leave it off with.
I love that. And okay, that's a great place to leave it off. And I'm going to leave it off with this. Our Austin economy continues to have weekly announcements. And I know I've said it in the past about dating the rate and marrying the house. And the consideration for that, to Mark's point, is put that money away, because we don't know what those rates are going to be in a couple of years when you do go to refi. And so they may be lower, in which case it's great. And then you can keep paying down the same amount and pay your note down faster. Or they may be higher, in which case we want to make sure you have reserves put aside so that you're not in a position where you have to sell your home, but you are in a position where you may choose to sell your home.
That right there is the point. Absolutely.
Yeah. All right. Well, with that said, my name is Jennifer S. Goodman. I am a realtor here living in Austin, Texas, and I am with
Mark Koretsky, loan officer Mark, Movement Mortgage. Give me a call.
All right. Thanks so much for tuning in. And as always, we would love to hear your comments, your thoughts, your considerations. If you have friends and family working with Bank of America or who may need help, if you are in the Austin market and you're looking at what your home values are currently, your insurance, all of those things, we would love to hear from you. So thanks so much for tuning in. We'll catch you next time.